Hello, this is the second podcast on how to actually prepare yourself for the IA2 exam and what you need to do in your perusal time of 15 minutes. Now, last one we actually went through all of the profitability ratios, that being the gross profit, net profit, return on owner's equity, and return on total assets. This podcast is looking at the liquidity ratio, and in particular, the asset turnover of accounts receivable ratio, the current ratio, the quick asset ratio, and also the inventory turnover. Now, the key issues with regards to these four financial ratios is the following. With the current asset and the quick asset, we're looking at the decrease in cash and liquidity issues. So if the current asset is decreasing, more than likely your cash at bank is decreasing as well. And with the accounts receivable turnover, look at the managerial policies in relation to granting of credit. And with the inventory turnover, you're specifically looking at the issue of economic order quantity and also the increase in supplies expense or cost of goods sold for the actual business itself. We are going to use the same question as we did for the last podcast, looking at Dewey, Cheaton and Ho and in relation to their profit and loss and also statement of financial position. So looking at these ratios here, the current ratio here has gone from 3.1 is to 1 down to 1.39 is to 1 with the industry average of 2.5 is to 1. So this ratio here should be around 2 is to 1, and because this has decreased, this is immediately showing that the business has a liquidity issue with regards to running out of cash. So this ratio should be about 2 is to 1. We can see here from the inventory turnover, it's gone from 68 days completely turnover down to 48 days, which is an improvement. We wanted this to be low as possible with the industry averaging around 55 days. With the quick asset ratio has gone from 1.16 is to 1 down to 0.84 is to 1, with the industry average being around 1 is to 1. And so therefore this has showing a huge glaring in the cash flow issues, and more particular probably reliance on the inventories in order to prop up this ratio. Accounts receivable ratio has gone from 66 days of payment for debtors to actually pay their accounts to 74 days. So you traditionally want this as a business around the 30 to 40 day mark. So this increase again is showing a glaring issue of lack of liquidity going into the business. So we're going to now look at the current ratio itself. So you can see here the current ratio. The main things that is going to affect the current ratio is obviously the net profit. So if the net profit is going down, there is a lack of money going into business to fund the day-to-day operations of the business and also the expansion of the business through the acquisition of assets. Now we can see here from our financial statements here, our net profit has gone from 40,000 down to 24,300. In our statement of financial positions, the main accounts which you're looking at here is inventories, accounts receivable, and cash at bank. Now with this ratio, the current ratio can also be looked at in comparison to the quick asset ratio as well. So you can do both as ones. The only difference between the two is that the current ratio includes inventories, the quick asset does not. Okay, so the quick asset actually shows that they're probably relying on inventories to prop up this ratio, which isn't a good outcome for the business. So we're going to look at these three accounts now in the statement of financial position: inventories, accounts receivable, and cash at bank. Now we can see here last year we had a small balance in our cash at bank account, which is of $2,200. Now we've got a bank overdraft of $10,000. So this basically shows that due to the decrease in profit, we have incurred a loan to the business in terms of our day-to-day banking account, which is not a very good outcome for the business as well. Accounts receivable has gone up from 20,685 to 29,550. So we can see here that will have a corresponding increase in our credit sales. So if we go to the statement of profit and loss, we can see here our credit sales has gone from 110,000 to 164,640. We like that our sales have gone up, but what we don't like is the amount of increase in accounts receivable due to people not actually paying their account. And this will be explored further in the accounts receivable turnover ratio. Our cash at bank, as I said, has gone down. If we look at our inventories account, we will notice here with our inventories, it has gone decreased from 40,000 to 20,000. So therefore, we can see that our inventories may have resulted from the decrease in the ratio, but the most important thing here is our lack of cash. Because we've got no cash in the bank, it will have a flow-on effect of the following accounts. One, you can see here accounts payable has gone up from 15 to 20,000 due to us not actually having any money in the bank. And also, you need to look at how we're actually financing our day-to-day operations and also the expansion of the business. So in terms of day-to-day operations, we look primarily at our bank account. And for the expansion of the business, we look at our non-current assets. And we can see here our furniture, plant and equipment has gone from 13,340 up to 27,000, an increase of approximately $14,000, which is basically the difference between our bank account having a positive 2,000 down to a negative 2,000 as well. So we funded this furniture and equipment primarily on debt, which is not good for the business. We also need to look at what's happening with our loans. So you can see here with our mortgages, we are not actually paying any of that off, which in essence has created an increase in our interest on loans. So our loans gone from 6,000 to 8,960. So we need to reduce that debt so we can improve our net profit and also improve our financial ratios, that being our net profit ratio and also our current ratio and owner's equity ratio as well. So in terms of liquidity, we are not in very good shape. The next thing that you need to look at is with regards to the quick asset ratio, what has actually happened here. Since we've taken off our inventories, you can see here that has a massive decline in the actual ratio itself. So that inventories amount is actually propping up this current ratio. If we had less inventories, we would be in also more financial trouble in terms of liquidity. Moving on to our return accounts receivable turnover, you can see here it's gone from 66 days to 74 days. So that is a difference of 8 days, which basically means that it is taking 74 days for our accounts receivable to actually pay our debts, which is not a very good outcome for the business at all. Now, what is actually affecting this turnover? So we can see here our credit sales and what is happening with our bad debts. So as a result of this increase in our accounts receivable and credit sales, is that also increasing our bad debts? So again, we look at the statement of profit and loss, and you can see here our bad debts has decreased from $5,500 to $3,300, but still not a very good outcome considering we need all the money we can actually get due to our liquidity issues. So this basically shows us that the accounts receivable policy probably is not working as best as it should due to our bad debts occurring and also our ratio increasing by 8 days. So therefore, the business must look at that policy and also looking at what type of people or organizations we are granting credit to. So in the statement of financial position, you are going to be highlighting in your perusal time your accounts receivable control. Okay, again, this is an important account in terms of our current asset, but also our turnover of accounts receivable. So it can be both in orange and green as well. And also our cash at bank. If we're not getting money from our accounts receivable, that means we are not getting money in order to fund the day-to-day operations of the actual business. As you can see here, our bank has gone down. So therefore, this policy of granting credit to accounts receivable is not working. Now, it'll have a negative effect on the following ratios. Because this isn't working, you'll probably see our sales, our credit sales have gone up, which is good, but however, we want that to obviously turn into cash, which is not happening at the moment. Furthermore, we need to look at our cash flow statement. So our cash receipts from customers in our cash flow statement might be decreasing, which means, again, we have a cash flow problem. And also, as I said, because this policy is not an effective one, we'll have bad debts expense, which is obviously the case in this ratio, in this business here. Our bad debts is still hovering around the $4,000 to $5,000 mark. In terms of our inventory turnover, this turnover looks at how quickly we can turn over all of our stock from the business itself. So we want this ratio to be as low as possible. Now we have a look here. Our inventory has actually improved from 68 days to 48 days, which is really good. So therefore, our advertising is probably working, but also our inventories are meeting the client needs. Okay, so in terms of this ratio, from the statement of profit and loss, there is only one main account, and that is our cost of goods sold. Now you can see here, our cost of goods sold has gone from 175,000 to 229,000. So what we need to do is we need to look at what is the percentage increase in our cost of goods sold from last year. So in order to do that, you get the current year cost of goods sold, which is 229,000, take away last year's cost of goods sold, which was 54,000, and then divide that by the 229,000. And you can see here there's been an increase of 23.58%. These percentages will be given to you in the exam. With our credit sales, take 124,640 minus your 110,000. That gives you 14,640. Divide that by the current credit sales. You can see here our credit sales only went up by 11%. If we look at our total sales, it went up by 13.5%. So you can see we have bought way too much stock in the year that hasn't actually returned into the sales. So we've got a pricing issue with the amount that the suppliers are actually costing us to the business. Now, another thing that you need to also look out for in order to further substantiate that the cost of our supplies is way too much and it's costing us our gross profit and also our liquidity, is to look at the cash flow for payments to suppliers and employees. So you might get an excerpt from in your exam which looks at the cash flow for payments to suppliers and employees. So what that basically represents is the cash that we have actually paid for our wages and also for our supplies in order to run the business. So that has increased as well, and we can see here that our cost of goods sold has increased by 24% and our total sales has only increased by 11%. We can see here that we're paying way too much for our supplies, which will have a negative effect on our profit, which has gone down, and also our gross profit as well, which has gone down as well. So looking at these ratios, so our net profit ratio has gone from 14 to 7, and our gross profit ratio, which isn't on there, Our gross profit ratio has gone from 36.36% down to 27.98%. All of these ratios will actually be given to you, okay, so you don't need to actually calculate them. In your exam, also your vertical analysis in terms of the percentages will also be done for you for the statement of profit and loss and also the statement of financial position. So we can see here with our inventory turnover, even though it is actually improved, we have an issue here with our stock costing too much from our suppliers. Again, in summary, with our accounts receivable turnover, it has worsened, okay, which has a flow-on effect for the liquidity, the cash at bank, and also ability to pay for the day-to-day operations of the business and also expand the business. Again, that is substantiated through our current and quick asset ratio, which have both declined. So in the exam, these are the most important accounts which you should highlight and obviously discuss in terms of the issues with and the trends and also the relationships between all of these accounts. There will be a exemplar for your written report, which will highlight also the explanation of issues, the trends and the effects of the trends, and also the relationships between the ratio and other ratios and accounts in due course. Thank you.